Welcome to today's deep dive. We are unpacking a pretty heavy stack of notes, charts, and proprietary research today.
Yes, we are. This material comes directly from a senior forex educator with over 10 years of specialized experience on actual institutional trading desks.
Right. And our entire focus today is directed at one specific asset, which is XAUUSD, so the spot market for gold.
Exactly. We are dismantling the framework of institutional market mechanics. We're diving deep into smart money concepts, or SMC, and specifically looking at liquidity.
And the mission today is really to move you, the listener, away from the frustration of emotional reactive trading. We want to provide you with absolute professional clarity.
That is the goal. We are going to examine why you keep getting trapped by those explosive market moves. And more importantly, we will teach you how to stop chasing those rapid candles.
We really need to build a mental framework that allows you to just sit patiently and wait for fair value. But, before we get to the solution, we have to honestly examine the problem.
We do. We need to talk about the trap you are likely falling into every single week.
Right, so picture the screen right in front of you. You are watching a gold chart on, say, a Tuesday morning. The price has just been chopping sideways for hours.
It's trapped in a tight, unpredictable range. Nothing is happening.
Yeah, and you feel that boredom setting in. That's a specific kind of mental fatigue from just staring at stagnant numbers. Your focus drifts.
And then, entirely without warning, a massive green candle explodes upward on your chart.
It tears through the moving averages. It breaks through every single resistance level you meticulously drew earlier that morning.
The momentum is visibly violent. You can actually see the candle pulsing upward tick by tick.
Exactly. And you feel the panic rising in your chest. The overwhelming fear of missing out completely takes control of your rational mind. You feel the desperate urge to catch the why.
Right, you are chasing price because you cannot bear the thought of letting this massive profitable move leave without you on board.
So you react. You surrender to the emotion and you just click the buy button.
Yep.
You buy at the absolute top of that giant green candle.
You hold your breath. For a fleeting second, you feel the thrill of participation. You are in the market.
But then the inevitable reality sets in.
The market stalls. The undeniable momentum you thought you were joining suddenly evaporates into thin air.
The current candle closes. The next candle opens and immediately bleeds downward.
Then the next one follows. Your screen turns entirely red.
You watch helplessly as the price grinds lower, inch by agonizing inch, eating away at your equity.
It reaches your predetermined stop-loss order. You are violently kicked out of the trade. You have taken a loss.
But the true psychological damage, the part that makes you want to quit trading altogether, happens exactly 1 second later.
The very moment your stop-loss is triggered, the price touches an invisible, unmarked level on your chart. It instantly reverses.
It rockets back upward in your original direction, leaving you behind in the dust. You just sit there feeling personally targeted.
You feel as though the market makers were watching your specific account, like they were waiting for you to capitulate before allowing the market to move.
But they were not watching you. You didn't experience bad luck. You fell into a highly engineered, mathematically precise trap.
Exactly. You were punished because you completely ignored the FVG.
And that sequence is the universal pain of the retail trader. It is a cycle of intense frustration that just slowly drains both capital and confidence.
It drains everything. And when I first read through our source material, the concept of the FVG immediately stood out as the core mechanism behind this trap.
But I want to make sure we are visualizing this correctly from the start, because when a beginner hears the term fair value gap, it's incredibly easy to assume it's just an empty box on a chart.
Yes, people think it's like a skipped step on a staircase, a simple void where no trading happened to take place.
Right. Is that all it is? Is it just empty space that we draw a rectangle around?
Viewing it merely as an empty box is a fatal oversimplification. That mindset will keep you trapped in the retail cycle.
So it's more than that.
Much more. A fair value gap is not just empty space on a screen. It is the physical, undeniable footprint of institutional urgency.
Institutional urgency.
Okay.
Yes.
It represents a precise moment in time where buying and selling activity became fundamentally, violently unbalanced.
I see. So to truly grasp this, you must step away from the chart for a second and understand the actual mechanics of the order book.
Precisely. Every single transaction in the market requires a counterparty. For every buyer, there must be a seller at that specific price.
Right. So when a major financial institution like a central bank or a massive hedge fund decides to move, say, $500 million into gold, They do not have the luxury of time.
No, they cannot sit and wait for retail traders to slowly sell to them. They execute massive, aggressive block orders.
And these orders are so extraordinarily large that the opposing side of the market cannot possibly absorb them at the current price level.
There simply isn't enough liquidity resting there.
Wow. So as a result, the algorithmic matching engine is forced to rapidly skip price levels. It's jumping higher and higher just to find enough willing sellers to fill that massive institutional order.
Exactly. And the gap left behind on your chart is the visual evidence of that aggressive displacement. It is the trail of destruction left by a whale entering a small pond.
So we aren't just looking for any large, fast candle. We are looking for a very specific structural pattern that proves this institutional urgency actually occurred.
Right. The sources we are reviewing are remarkably strict about the geometry required to define this footprint.
They define the FVG exclusively as a 3-candle sequence. So let's break down exactly what the listeners should be looking for when they stare at their gold chart.
Okay, let's do it. The first candle in this sequence is what the sources call the anchor.
Right. And if we are analyzing a bullish move, like an upward explosion of price, we need to focus our attention on the highest point of this first candle.
We're looking specifically at the top wick. That top wick establishes the starting boundary, the floor of our potential gap.
Okay, so the first candle sets the absolute baseline of the event. It represents the last moment of normal, balanced market activity before the injection of institutional capital.
Then comes the second candle. This is the displacement candle.
This is the impulsive, violent move that caught your attention and triggered your fear of missing out in our opening scenario.
Exactly. And structurally, this second candle must have an abnormally large body compared to the recent price action.
Furthermore, it should have minimal to no wicks on either end, because wicks represent hesitation, right?
Yes. Wicks represent a battle between buyers and sellers. A massive body with no wicks indicates that there was absolutely no hesitation and no battle.
It was a complete capitulation.
It is the pure, unadulterated injection of institutional volume. But here is the critical rule. The gap does not officially exist until the third candle closes.
Where the third candle provides the confirmation.
Once the third candle closes, we examine its lowest point. We look at its bottom wick.
And if the bottom wick of this third candle fails to reach all the way down and touch the top wick of the first candle, we have a confirmed event.
Exactly. The empty vertical space left between the wick of candle 1 and the wick of candle 3 is your fair value gap.
That vertical space is where the market literally skipped a step. But this brings up a massive point of confusion for many beginners. I want to push back on the terminology here for a moment.
Go ahead.
You often hear the terms gap, imbalance, and inefficiency used interchangeably by traders online.
All the time, yes.
For example, people will see a massive jump in price over the weekend. The market closes on Friday and opens 50 pips higher on Monday. They look at that empty space and call it a fair value gap.
Which is incorrect. We need to be rigorously precise with our language here if we want professional clarity.
So are we saying that a fair value gap is the exact same thing as an imbalance?
They are closely related, but they are absolutely not identical. Conflating the two will lead to significant execution errors.
Okay, so how do we separate them?
Imbalance is the broad, overarching category. It is an umbrella term. It describes any situation across any time frame where price delivery is inefficient or disjointed.
So a weekend gap, where the market closes on Friday and opens at a vastly different price on Sunday night due to weekend news, that is a prime example of an imbalance.
Yes. However, a fair value gap is a highly specific structural subset of an imbalance.
It is defined exclusively by that rigid, geometric 3-candle pattern we just discussed.
More importantly, it must occur during active, continuous trading hours. It requires a live operating market to form.
Understanding this distinction is vital because of how the trading algorithms treat these specific 3-candle intraday gaps.
Right, because the gold market operates as an ultimate efficiency-seeking machine.
When that massive second displacement candle prints on the chart, it moves so incredibly fast that many of the institutional limit orders sitting in the order book are simply bypassed.
They are left partially unfilled. The gap represents unfinished business for the algorithms.
Therefore, the market acts as a heavy, undeniable magnet. It is mathematically compelled to pull the price back down into the exact territory of that FVG.
It must rebalance the exchange between buyers and sellers. It has to offer fair value to both sides before the overarching institutional trend can safely and sustainably continue.
Okay, this rebalancing act completely explains the painful scenario we described at the very beginning of this show.
It really does. You bought at the exact top of that massive displacement candle.
You bought right at the precise moment when the algorithmic matching engine realized it needed to go back down and fill the unfinished business left behind by the institutional whale.
You were stopped out not by bad luck, but by the market's natural mechanical requirement to seek efficiency. The market had to rebalance.
But this brings me to a crucial question about our specific focus today. Why are we dedicating this entire strategy specifically to gold?
That's a great question.
Does XAUUSD really behave that much differently than trading a standard currency pair like the euro or the Japanese yen? Why is this specific asset the perfect hunting ground for these gaps?
Gold possesses a completely unique market personality. You cannot treat it like the euro or the pound. It is the gold standard of market volatility.
So it operates under a different set of rules.
It operates simultaneously under three distinct identities. It is a traditional safe haven asset during times of crisis.
Right. And it is an industrial commodity used in manufacturing.
Yes. And finally, it is a proxy for global currency strength. It specifically acts as the counterweight to the US dollar.
Because of this complex, intertwined identity, gold is hypersensitive to macroeconomic drivers.
Extremely sensitive. When inflation data drops, when a central bank changes an interest rate, or when a geopolitical shock occurs overnight, gold reacts instantly and violently.
Consequently, the gold market is the primary battlefield for the most capitalized entities on Earth.
Central banks, sovereign wealth funds, and massive commodity trading advisors do not trade standard currency pairs with the same raw, unchecked aggression that they apply to gold.
Wow. When they enter the gold market, they don't just participate, they dominate.
And when they dominate, they leave massive, undeniable footprints. Their size physically breaks the efficient delivery of price, leaving behind the exact structural gaps we are looking to trade.
Our sources actually outline a very specific behavioral sequence for gold, particularly around major economic news releases.
Yes, the news sequence is critical.
Let's think back to a massive event, like the release of the Consumer Price Index or the non-farm payrolls report. The notes describe this as a four-step news-driven sequence.
Let's walk the listener through exactly what happens to the chart minute by minute during one of these chaotic events.
Okay, the first step the sources identify is the pre-release huddle. If you watch the chart an hour before the news drops, the market goes eerily quiet.
The candles get very small. Price consolidates into a tight, sideways, restrictive range.
Every single participant in the market is sitting on their hands waiting for the data to drop.
That tight consolidation is not just boredom. It is the physical building of immense market pressure. It is the calm before a guaranteed storm.
The algorithms are pulling their liquidity, waiting for direction.
Then comes step two, which is the shock. The data is officially released to the wire.
In a fraction of a second, high-frequency algorithms process the inflation numbers and trigger massive block orders.
You immediately see a violent displacement move on the chart. It is like a sprinter blasting out of the starting blocks at the sound of the gun.
And this move is so incredibly fast, and the volume is so overwhelmingly large, that it creates a massive fair value gap.
Retail traders see this sudden shock. They see the giant candle forming, and they panic.
They feel the overwhelming urge to jump in immediately before it's too late.
But the professional institutional trader does absolutely nothing. They do not chase the shock. They simply sit back and wait for step three.
Step 3 is what the notes call the digestion phase. That initial explosive news candle finally closes.
Suddenly, the intense momentum stalls out. The market participants are now reading past the headline number.
They are digging into the fine print of the economic report. They are analyzing the revisions from the previous month and the subcomponents of the data.
As this analysis happens, the price action becomes heavy. It becomes sluggish.
The aggressive buying or selling abruptly stops. And this hesitation leads directly into the final, inevitable phase of the sequence.
The fourth step is the magnet pull. As the market digests the news, the algorithmic engines realize that the initial shock left a massive void of liquidity behind.
The price delivery during that first explosive minute was entirely inefficient.
So the algorithms step in and force gold to retrace its steps. The price violently pulls back into the very fair value gap that was created during the initial shock.
It returns to fill the void. It drops down to pick up the remaining institutional limit orders that were bypassed during the panic.
Only after that gap is completely mitigated, only after the market is balanced, does gold resume its true news-driven direction.
Think about the tragedy of the retail trader here. If you bought during the Step 2 shock, the Step 4 magnet pull absolutely destroyed your account.
It hit your stop loss with precision. But if you understood the sequence, if you waited patiently for the magnet pull to rebalance the market, you entered safely.
You traded precisely alongside the banks? But, this requires a massive psychological shift in perspective.
You have to train your brain to see a giant green candle not as an invitation to buy, but as a warning sign of an upcoming retracement.
But this introduces a new, very real danger for the beginner. Once you learn to spot that specific three-candle structural pattern, you start seeing it absolutely everywhere.
It is exactly like buying a new red car.
Right, you drive it off the lot, and suddenly, every single street you drive down is filled with red cars.
Yeah.
They were always there, but now your reticular activating system is highlighting them.
If you open a 5-minute gold chart right now, you will easily spot dozens of fair value gaps scattered across the day.
If you blindly place a buy or sell limit order at every single gap you find, you will drain your trading account just as fast as you did when you were chasing price.
An isolated gap is not a complete strategy. That is a critical warning.
So an FVG by itself isn't enough.
An isolated fair value gap is inherently weak. On its own, it is nothing more than a temporary mathematical price anomaly.
So how do we filter them?
To turn a simple gap into a highly probable professional trade setup, you must apply the rigorous, unforgiving context of market structure. A gap means nothing without structure.
You must identify whether the broader market is currently experiencing a break of structure, which we refer to as a BOS, or a change of character, known as a CACH.
Let's define those clearly for the listener. A break of structure occurs when a prevailing trend simply continues.
It breaks past a previous established high or low to form a new one.
Exactly. A change of character is much more significant. It is the initial early warning signal of a total trend reversal.
It is the moment the market fails to make a higher high and instead breaks below a previous structural low.
A fair value gap only matters. It only carries institutional weight if it is the direct physical cause of one of these structural shifts.
If a gap forms in the middle of nowhere and breaks no structure, you ignore it entirely.
Correct. And this is where we need to introduce what the sources call the liquidity sequence.
This sequence is the filter. It is the exact timeline that separates the random, meaningless gaps from the highly engineered institutional setups.
This is where we define internal versus external liquidity. Let's break this down carefully.
Step 1 of this high probability sequence always, without exception, begins with a liquidity sweep.
The market intentionally, aggressively drives the price past a highly visible, obvious high or low.
For example, they will push the price just barely above the absolute highest point reached during the entire Asian trading session.
This high is considered external liquidity. It is a boundary. Why do they push price past this boundary? They are hunting for retail stop losses.
I need you to clarify the reality of that stop hunt, because retail traders often take it personally. They think the broker is out to get them.
The institutions are not hunting you out of malice. They do not care about your specific account. They are hunting those levels out of absolute mathematical necessity.
Right, remember our earlier discussion about order blocks. Institutions need immense concentrated liquidity to fill their massive orders without causing severe slippage.
Your stop loss order, resting just above that Asian high, provides exactly that liquidity.
When they sweep that high, they intentionally trigger thousands of retail buy-stop orders. The retail traders think it's a breakout.
The institutions, however, instantly sell into that artificial engineered buying pressure. They use your buy orders to fill their massive sell orders.
This brings us to step 2 of the sequence. Using that newly captured external liquidity as fuel, the institutions aggressively, violently reverse the price direction.
This violent reversal is the displacement phase. This is the exact moment the high probability fair value gap is formed on the chart.
That is a harsh but necessary realization. The gap you are looking to trade was literally created using the captured fuel of trapped retail traders who bought the fake breakout.
It's the reality of the market. Then comes step 3, which is the retracement.
The aggressive displacement ends. The price slowly, almost agonizingly, pulls back up into the newly formed gap.
This is what we call internal liquidity. The market is returning inside the structural range to rebalance the books.
It returns to the FVG and the institutional order block that initiated the entire move.
Finally, we reach step 4, which is the continuation. The true, sustained institutional market move begins, leaving the trapped retail traders completely behind.
This entire 4-step sequence perfectly defines the exact behavior of smart money.
They engineer the external sweep, They create the internal gap, they wait for the retest to mitigate their remaining orders, and only then do they deliver the true price.
Recognizing this sequence in real time requires you to differentiate between genuine institutional intent and random market noise.
And the sources use a brilliant analogy for this that I want to spend some time on.
Yes, they compare reading market structure to defending against a fake pass in basketball.
Think about a point guard driving down the court. When the point guard throws a fake pass, the amateur defender watches the ball.
The defender's eyes track the object. When the guard fakes, the defender lunges completely in the wrong direction, leaving themselves totally exposed.
But the professional defender doesn't watch the ball. They watch the player's hips, they watch the floor space, they watch the structural intent of the player.
If I try to apply this to the chart, I assume the green candle is the basketball.
Exactly. Retail traders stare at the shiny, rapidly moving green candle. That is the ball.
When it shoots up, they lunge and buy. But what is the floor space? Why do institutions ignore the candle and watch the floor?
The floor space represents the established liquidity pools. The institutions are watching the structural boundaries of the market, the previous highs and lows where capital is resting.
You are exactly right. The retail trader lunges at the shiny green candle, entirely blind to the fact that the candle is driving directly into a major resistance zone designed to trap them.
To trade like a professional, you must stop watching the ball and start reading the intent behind the displacement.
You have to ask yourself, what did this specific move actually accomplish? Did it break a major structural boundary, or did it just look flashy?
The sources divide market displacement into two very distinct categories to help you read this intent. The first category is strong displacement.
This is the genuine, structurally significant breakout.
A strong displacement smashes violently through a major respected liquidity pool, not just a random minor high on a 1-minute chart.
The momentum is so real that it sustains itself for multiple consecutive candles after the break. It leaves behind a clear, wide, undeniable imbalance.
When price eventually returns to this specific gap, it is highly respected by the algorithms. The institutions defend it.
And the opposite of that would be the trap. How do we spot the fake pass on the chart before we get caught in it? I assume it looks identical at first glance.
It does look identical initially, which is why it is so dangerous. The opposite of a strong displacement is a liquidity trap displacement.
This is the fake out.
In this scenario, the market snaps quickly through a very small, relatively insignificant price level. It looks exactly like a breakout for exactly one candle.
The retail traders lunge, but then the momentum stalls instantly. There is no follow-through.
The heavy institutional volume simply isn't there. The minor fair value gap that was just created is aggressively filled and completely invalidated within the exact same trading session.
The retail trader bought the breakout, trusted the gap, and was trapped because they didn't verify the structural significance of the level that was broken. They watched the ball.
This means we need a reliable way to filter out those low probability traps.
And when it comes to XAUUSD, time of day plays a massive, critical role in determining whether a move is genuine or a fake pass.
You cannot sit at your desks and trade every single hour of the 24-hour cycle with the exact same expectations.
The sources specifically and repeatedly warn against trading during the Asian session.
Fair value gaps formed during the Tokyo and Sydney operating hours are notoriously unreliable.
They are often low-volume, choppy overlaps. They represent structural noise rather than institutional intent.
If I see an FVG form at 3 a.m. Eastern Time, I should probably ignore it. The high-probability setups, the genuine institutional displacements, seem to occur during very specific scheduled windows.
Time is just as important as price.
The premier window for high-probability setups is the London Open. This is the precise moment when the heavily capitalized European institutions enter the global market.
They wake up, review their charts, and routinely look back at the quiet, sideways, restrictive range that was established during the low-volume Asian session.
Their algorithmic systems intentionally sweep those Asian highs or lows to gather the necessary liquidity, and then they initiate a massive, genuine displacement.
The other critical, highly reliable window is the New York session overlap.
This occurs when both the London and Wall Street markets are simultaneously active and overlapping. The volume during this window is immense.
If you identify a fair value gap forming specifically during these tight time windows, and that gap is backed by a fresh sweep of Asian liquidity, the probability of your setup succeeding increases exponentially.
You are no longer just treating a geometric shape on a screen. You are actively aligning your technical pattern with the actual ticking clock of global capital flow.
Okay, let's pull all this theory together into a concrete plan. We understand the mechanics of the trap. We know to look for the liquidity sweep.
We watch the displacement occur specifically during the London Open or the New York overlap.
We identify a clean, valid 3-candle fair value gap that caused a structural shift. We have the perfect setup.
Now comes the absolute hardest part for any beginner trader.
Execution. The physical clicking of the button. How do we take all this high-level knowledge and build an actual mechanical entry without guessing, without hesitating, and without giving into our emotions?
Execution is where theory meets reality. You must fundamentally replace your emotional, reactive market buying habit with a strict, unyielding confirmation sequence.
You do not ever place a market order simply because you see a gap form on the screen.
Step 1 of proper execution is absolute unwavering patience. You must wait for the retracement to occur.
You identify your fair value gap zone on a higher time frame, such as the 1-hour or the 15-minute chart. You draw your rectangle.
And then you sit on your hands. You do absolutely nothing. You let the price slowly, heavily bleed back down into that defined zone.
The sources mention a very specific mathematical level inside that zone, called consequent encroachment.
It sounds highly complex, but it is simply the exact 50% midpoint of the fair value gap rectangle.
Why is that specific 50% mark so important? As a beginner, my immediate fear is missing out. I'm thinking, wait, if I stubbornly wait for the price to drop all the way to the 50% mark, aren't I risking missing the trade entirely?
What if the price just barely taps the top edge of the gap and then rockets away?
Exactly.
That fear of missing out is exactly what you must conquer. Yes, occasionally price will tap the outer edge and leave without you. You must accept that.
But the 50% level, the consequent encroachment, represents the absolute equilibrium of the imbalance.
Market algorithms are meticulously programmed to seek deep efficiency. Often, simply touching the shallow outer edge of the gap is mathematically insufficient to satisfy the algorithm's strict requirement for balanced price delivery.
To truly rebalance the order book, the price will frequently pierce deep into the heart of the gap.
Tapping the precise 50% mark, the absolute equilibrium, before violently rejecting it and reversing.
Waiting for this deep penetration is a signature of algorithmic precision, and it significantly improves your risk-to-reward ratio. You are entering at the best possible wholesale price.
Okay, so we wait patiently. The price finally enters the gap, it slowly bleeds down and approaches that 50% equilibrium level.
But we still do not just blindly place a buy order and hope for the best. We demand one final layer of proof.
We demand lower time frame confirmation. We drop our charts down from the 15-minute overview to the 5-minute or even the 1-minute time frame.
We focus our eyes entirely on the price action, happening purely inside the boundaries of our higher time frame gap.
What exactly are we looking for in that microenvironment?
We are looking for a micro change of character. We want to see a smaller, identical structural shift, or a clear, undeniable candlestick pattern like a bullish engulfing candle forming entirely inside the FVG zone.
That lower time frame confirmation is your definitive trigger to enter. It is the final piece of the puzzle.
It mathematically proves that the institutions have stepped in and are actively defending the gap at that precise moment. It tells you the retracement is over.
Furthermore, you can achieve a highly coveted double confirmation by combining your fair value gap with an order block.
An order block is simply the last opposing down-close candle that formed immediately before the massive upward displacement began.
If your newly formed fair value gap sits directly on top of or overlaps with a valid order block, you have discovered an area of immense concentrated institutional interest.
The probability of the algorithm successfully defending that specific price zone is exceedingly high.
We must also address the harsh reality of risk management. Even the most perfectly aligned, double-confirmed setup can fail. The market owes us nothing.
If we are waiting for this precise confirmation and we finally enter the trade, where exactly do we place our stop loss?
The sources are incredibly adamant about this specific rule. You never, ever place your stop loss inside the noise of the gap itself.
Placing a stop loss inside the gap is asking the algorithm to sweep your account. The gap is a zone of turbulence.
Your stop loss must be placed logically, structurally, at the exact point where your entire overarching trade thesis is proven demonstrably wrong.
You place it safely below the originating order block, or just beyond the extreme lowest wick of the displacement candle that started the move.
If the market aggressively breaks down through that foundational level, it means the institution is no longer defending the zone. The trend has failed.
The trade is dead. Accept the small, controlled loss immediately.
You then define your profit target by looking for previous unmitigated swing highs or external liquidity pools, ensuring your mathematical risk-to-reward ratio is never less than a strict 1 to 2.
You risk 1% to make 2%, mathematically guaranteeing long-term survival.
We have covered an immense amount of ground today.
We really have. We have thoroughly transitioned away from the painful, account-draining frustration of buying massive green candles at the absolute top.
We have unpacked the literal algorithmic mechanics of why the market reverses exactly when it does.
We have learned to read the physical footprint of institutional urgency, and we have built a mechanical framework to trade it safely.
It is time for you to fully internalize the real realization of this entire methodology.
The institutional market makers are not your enemy, but they are entirely coldly indifferent to your success.
They literally profit directly from your emotional FOMO during the displacement phase. They mathematically require you to panic by the top of that explosive green candle.
They need your retail capital to serve as the required liquidity for their massive positions when the price inevitably retraces to fill the fair value gap.
Once you deeply, fundamentally understand this ruthless mechanic, your entire perspective shifts permanently. You stop being the reliable victim of arbitrary stop hunts.
You step out of the engineered trap. You learn to embrace patience, and you finally begin trading alongside institutional intent rather than against it.
This deep dive has provided you with a strict mechanical blueprint for patience. It is a roadmap to professional clarity in the highly volatile gold market.
But before we officially conclude, consider this final provocative thought.
The market on your screen is not a chaotic, random sequence of unpredictable candles reacting to human emotion. It is a highly engineered, relentlessly efficiency-seeking algorithm.
Every single gap you see on your chart tells a very specific, undeniable story of an unfilled, multi-million-dollar order waiting in the dark.
The next time you sit at your desk and you see a massive, explosive green candle suddenly form on your gold chart, instead of feeling that familiar panic, instead of feeling the overwhelming urge to jump in blindly and chase the price, stop and ask yourself this single question.
Who exactly is creating this void, and where are they quietly waiting for me to hand them my money?